A market soars to impossible heights. Fortunes are made overnight. Then the whispers of doubt begin. The music stops, and everything comes crashing down. Why does the story feel so familiar? I'm Usama, and today we will discuss the timeless patterns of financial disaster guided by Charles P. Kindleberger's seminal work, Manias, Panics and Crashes. Published in 1978, Kindleberger's book is not just a history lesson. It's a diagnostic manual for financial epidemics. He argued that financial crises aren't random accidents. They follow a remarkably predictable psychological and economic script. It all begins with a displacement, a major external shock that creates new, dazzling opportunities for profit. Think of the discovery of the New World, the dawn of railways, or the birth of the internet. A fundamental change in the economic landscape. This displacement triggers phase 2, a credit boom. Money becomes cheap and abundant, flooding into the new hot sector. Here, rationality starts to fade. We enter the mania phase. Prices detach from reality, driven purely by the expectation that they will keep rising. The greater fool theory takes hold. You don't buy an asset for its value, but to sell it to someone more optimistic and foolish than you. But manias cannot last forever. The insiders who sparked the boom begin to quietly sell. Distress sets in as smart money exits. A single piece of bad news, a prominent failure, can then trigger the panic. The rush to sell becomes a stampede. Liquidity vanishes. This is Kindleberger's crucial insight. The panic threatens the entire system, not just speculators. Sound businesses can fail simply because they can't access cash. The solution? A lender of last resort. A powerful central institution that can provide emergency liquidity to halt the panic. This controversial but vital role, often played by a central bank, stabilizes the system. The crisis ends but often leaves a deep recession in its wake. Let's see this framework in action. The 1630s Dutch Tulip Mania is a classic example of displacement and absurd valuation. Tulip bulk contracts traded for the price of grand Amsterdam houses. The mania collapsed virtually overnight, ruining many. The 1929 crash followed the same script. Displacement from roaring 20s tech, credit-fueled stock mania, and a catastrophic panic with no effective lender of last resort initially. The 2008 global financial crisis featured a modern displacement. Financial innovation in housing debt. The mania was in complex mortgage-backed securities. When the underlying housing market turned, the panic spread globally. This time, central banks acted as aggressive lenders of last resort. So what are the lessons for us today? First, this time is different are the four most expensive words in finance. Human psychology, greed and fear remains the constant driver. Technology changes, but the emotional cycle does not. Excessive leverage and credit growth are the fuel. Monitor them closely in any new hot market. Finally, Kindleberger reminds us that financial stability is a public good. It requires prudent regulation and a credible backstop. Understanding this pattern won't prevent the next mania, but it can help you recognize its stages and protect yourself from its worst effects.